others, Bloomberg TV, CNBC, and quoted across the financial media. He is Chief Investment Officer for Coutts UK and will be giving his thoughts today on the prospects for the sterling bond market. Before we start, I might just add that Alan can give both sides of the fixed income story since as a large customer of the asset management industry and as a direct investor in corporate bonds. Alan has also been an institutional investor in a past life, and he's
it was a while ago now.
but lots of bases covered there anyway. Enough from me. We haven't got a long time. First off is a quick poll. Actually, we've got a poll. It'll be on your apps. Now the poll question is, what will be the impact on sterling bonds of the UK election result? First answer would be, it will lead to a softer Brexit, which is a good thing for borrowing costs. It will lead to instability and uncertainty, which is a bad thing for borrowing costs. Nothing will change. We've learned to live with uncertainty. Great, so that's the poll. So we'd love to hear your opinions on that. Alan, thank you very much for joining us. No beating around the bush. The first question I'll ask you, I'm going to split into two parts. Firstly, the impact of the UK election. We see this morning the DUP have now made no deal with the government, and the Queen's speech, I think, is today, isn't it?
Yeah.
So how do you see Brexit playing out? That's the first part. The second part, I'd like to paint a few Brexit scenarios and how those scenarios might affect the sterling bond market, or is it bulletproof?
Well, the sterling bond market does seem to be bulletproof, doesn't it? So on to Brexit, very difficult, but give you our scenario for what it's worth, and I think Philip Hammond mentioned this recently, the importance of transitional arrangements. Absolutely, that has to come first. So if you look at it from a game theory point of view, we know there's a degree of punishment that needs to be handed out by especially European politicians, and on the other hand, UK needs some kind of access. It can't be on the same terms, but some kinds of access. So punishment can be money, and obviously huge sums have already been mentioned. And we're looking for a scenario where there's a payment for transitional arrangements. And that could be a couple of years of basically continued membership, but definitively a payment for that. So that's the initial scenario. Impact on the UK bond market, obviously dominated by gilts, the underlying building block. Difficult because under that admittedly relatively optimistic scenario, obviously depending on the global economy, that looks like pro-risk on in the UK, pro a bit more positive sentiment. So if anything, you'll see a bit more upward pressure or some upward pressure in gilts, and maybe some tightening of credit spreads. So that's kind of our basic scenario is the transitional arrangements come first, and the tougher decision is put off for a couple of years. So which is the longer term agreement.
Kicking the can down the road a bit. And is that a best case scenario?
That is the best, and it's going to be difficult to get there. Why, let's look at it from Macron's point of view. He really has to get that French economy working. Okay, they tried Sarkozy. My French friends told me Sarkozy was the great hope. Sarkozy was going to change everything. They went socialist with Hollande. Now Macron, so whether it's the Michelin workers in Clermont or Champagne, the second biggest market for Champagne is the UK. The export markets to the UK needs to be open for France. Everyone talks about Germany, of course. We all know about Germany, the auto industry. So it's not completely one way. There is a game theory. There is a degree where politicians will be happy for the UK to pay a degree of money so that Michelin, LVMH, Alstom, Champagne, I'm picking on the French here, continues to come into the UK because Macron needs that French economy to work, just looking at it from his perspective. So yes, it is a bit optimistic, but it's based on my experience. Usually business wins out. Usually the business principles wins out. But it's risky. It certainly is risky on the way, and you can't rule out a scenario where we don't even have a decent transitional arrangement.
And so that's the best case scenario. What could go wrong? Because there was a lady I was talking to yesterday. She didn't even know what a black swan was until 7 years ago. And now she's seen so many you can't count them. What's a kind of worst case scenario for Britain in these negotiations? It didn't start well.
Well, that's because
I think we caved in on something.
I think let's face it, the European negotiators seem to have all the cards for the moment, and the idea, Theresa May's idea of no deal is better than a bad deal, that seems to have dissipated, and maybe that was badly put. It would have been better to be put in saying we really want to do a deal, we're really positive energy on this, but if it doesn't work out, maybe we have to. It was put it in a very negative connotation on the basis of a majority of 100, so that didn't work out. I mean, the black swan, I suppose, is no deal because, certain people, informed people, say it'll be fine. WTO rules, it'll be fine, everything will be good. But I think there'll be a degree of market pricing, or we'll be suspicious about that. Now, what happens to gilts? Most likely they rally, of course. Flight to safety, flight to quality. Yeah. So credit spreads, no doubt, will widen. Probably not just in the UK. But we have to bear in mind, we're talking about the sterling bond market. At the end of the day, it's all about the US economy. If we're talking the outlook for gilts, really, it's gilts relative and sterling relative. The big picture is the US economy, and secondly, probably China.
Right. And in terms of the currency itself, sterling itself, I think you said there's a quote in January. Sorry to throw your own quotes at you. Sterling is the gift that keeps on giving, and we're buying now.
So paraphrasing, that was.
Sorry,
that's your journalist, not as good as you, Charlie. Who took that. So what I meant there, people who manage UK money will be aware. Obviously, when a currency goes down, the returns in sterling have been very good. Yeah. But what we've been saying is that we're now positive on sterling. It looks a bit lonely. It looks like it's a rocky ride. So we're bullish on sterling. Why? Because if you look at the three Brexit dislocations, there was three basically. FTSE 250, this kind of medium impacted UK companies come back strongly. Commercial property, we had the commercial property funds freeze, have come back strongly as a market. We've seen some amazing deals. We've seen the cheese grater in Leadenhall Street sell for 20% more than expected to a Chinese buyer, so that's come back. What hasn't come back is sterling. So it's understandable because sterling bears the risk of Brexit, but we're buyers of sterling. It's a mean reverting currency versus its fair value. You can find fair value, and its speculators have been very short. But so far, I think it's fair to say we've been the best you can say we've been neutral. The worst you can say we've been wrong because sterling's actually gone down versus the euro a fair bit.
But do you see sterling as a currency that will strengthen, or will others weaken? I mean, is...
Okay, so that's a wider question. I mean, when we saw Trump, America first, we did translate that into, America first means Pennsylvania, Ohio, the Midwest first, has to mean a weaker dollar. Now, that's mainly admittedly against the Mexican peso, Chinese yuan, that's why the Chinese yuan's held up so well, but also potentially the euro with Germany. So we can see reasons for sterling dollar to edge up for dollar reasons.
Right.
So it is as opposed to sterling reasons. But I think it's fair to say our positive view on sterling will not come through if there's some kind of hard Brexit. It's unlikely to come through if there's some kind of hard Brexit, and you'd have to price in a lower value of sterling for the uncertainty of no deal, whatever no deal works out to be.
Whatever that means. Yeah. Nobody knows what that means. So could we talk a bit about rates, interest rates? We've got UK rates staying the same, so the US rates are ticking up, but UK rates in particular staying the same, and inflation at 2.9%. What's your view on central bank policy at the moment in the UK? Also very interested in the US, but we're talking about the UK. Sure. That policy at the moment, that sort of stagnant.
Well, we heard yesterday, didn't we, from Mark Carney, kind of really putting the three voters for a rate hike in the box, saying no, there's too much uncertainty. We saw this before in 2011, 2012, when inflation got to 5. Said it's temporary, we'll look through it. So I think they will. Having said that, we think the economy is on firm enough footing to take away the Brexit rate cut. So at some shade, that 0.25% Brexit rate cut we can see going, but it probably needs a bit of a stronger economy. They're data dependent, as they say, they're data dependent. Just like us, we look at the data and we say, okay. So it needs a bit stronger data for the UK, and I think those three can edge towards 5, and probably get them over the line and take away that Brexit rate cut.
Really? Okay. And do you believe in this kind of narrative that this year's reverse? So whereas last year you had US, UK growth, European stagnation, now we're kind of seeing Europe growth, UK, US stagnation. This Trump bump is now a sort of malignant Trump lump or something. I don't know.
Not so sure that, I mean, there seems to be a problem with US Q1 data. I think for the last 4 or 5 years it's been weak, yet the US economy has just done fine. I think you're right about Europe. The Eurozone is performing very, very strongly indeed. There's no doubt about that. So that is the standout. But I wouldn't say the UK or US is that weak. We're just after probably too much euphoria, we're coming off high levels.
So generally optimistic about the UK growth story, it's always called, going into the future. Yeah. We've got about 5 minutes left. I'm going to ask another question, but if anyone's only got any burning questions as we go along, do put your hand up and someone with a microphone will come. But I'm going to ask a question. I'm going to quote an article at you. Not your quotes again this time, so I surprised you with that one. I read that 84% of investors polled in the second quarter said corporate bonds were overvalued. 82% think government bonds are overpriced. I'd be interested, coming from Coutts, which has a fundamental principle to find value in unpopular places. I just wonder, where we might be finding some value now in UK sterling bonds.
Okay, so it's tougher. So if you break that down, there's no doubt, or we know that gilt yields are exceptionally low. But we learned from Japan, what should you have done when Japanese yields first went through 1%? You should have bought. If you think of it, a long-term investor, you earned 1% compound in Japan instead of 0% compound, the cash rate. So if you think of it from that perspective, so we have had a belief at Coutts that rates will be on the lower side. And I think that the message from the US market is that the fact that US yields are so low, despite no more QE, despite tightening, the message from the market is that whether it's Larry Summers' excess savings argument, I think it's important not to focus on just one investment principle, but the message from the markets is that it's not going to take much in the way of rate hikes to slow these economies. And that's the same in the UK. But UK looks poor value. So even though we probably have more bonds than a lot of people, we've sold out of a lot of our long-dated bonds. So where can you find value in the UK? Pretty hard now. I mean, we are a big customer of the asset management industry. So we're a big investor in CoCos, national champion CoCos, via the funds, obviously with Banco Popular. Yes. That's a euro-denominated, but there's issues like Lloyd's Sevens in sterling.
Could you see a Banco Popular in the UK happening?
Potentially, yeah. I think you could. I mean, we've got the co-op situation. You could sadly see the co-op given to someone for £1.
Yes.
And the lower tier two, I think co-op doesn't have CoCos, but it has subordinated debt. You can see that. But going back to your question, where is value? Very hard. We do like esoteric securities. We do like to be contrarian. So we're one of the few. We bought Mexico 100-year debt in sterling. Why do we do that? Behavioural.
Question, yes.
See, your response is behavioural because I can see a few bond investors in the house, and they will know the present value of that 100 in 100 years' time. It's less than 2 points, maybe less than 1 point today. It's irrelevant. The maturity becomes irrelevant when you do your bond geeky mathematics, which we have a few at Coutts who can do that for us. So it becomes behavioural, and it was just relative value. And another interesting point is uncorrelated. That particular bond has a very strange movement. It's quite uncorrelated. The one probably more people are familiar with, which was an absolute bargain a year ago, was Tesco bonds. The narrative was, we all know that it's a struggling sector, but the narrative that Tesco is close to default seemed very, very strange. So the Tesco secured property bonds, I think as a customer of the asset management industry, we see them in a lot of portfolios, and we have bought them directly. We have multi-asset funds at Coutts. So we're able to act semi-institutional by buying blocks of bonds. And those, so year to date, for example, the Tesco property bonds are up 15% because they went from an absurd 7% yield at one stage in Q1 2016. They're now sub 5. But there's a fair bit of value there. There's still some compensation. The issue is there's a lot of spread duration. So it's not for everyone. But that's an area. But other than that, it's a bit of a struggle right now. But the credit spread itself, I think someone said earlier, is on the expensive side, but in some ways not as expensive as equities. We all know about the Schiller P in the US equity market, for example. If you kind of then look at some of the credit spreads, they're expensive, but maybe not absolutely ridiculous as some.
Okay, excellent. Well, and also in terms of, very quickly, new issuance pipeline in the UK coming up, strong, healthy?
It looks like it's recovered, having been a bit of a, frankly, dead market in the sense of clearly if you're an American issuer, you tend to issue in euros. Even some British issuers issue in euros, some British companies issue in euros. That is obviously the large market. But there seems to be, helped by the mini QE, we had mini post-Brexit QE. We seem to get some issuance going, which is healthy. Pension funds have tremendous demand. One thing that surprises me, so these long-term pension corporate bond funds that we bought, very low fees. We had a guy from Vanguard here talking about, the guy who runs it, talking about low fees. Well, these are very low fees, high duration, which makes them have nice negative correlation versus equities, and should be ideal for pension plans, but they're actually quite small. We struggled to find them, and they're managed by PIMCO, Fidelity, and all of them are quite small. And it does surprise me that pension plans, who should be taking an ultra long-term view, don't earn that 1 to 1.5% compound extra credit spread over 30 years. Certainly, in my second job, I'm a non-exec of the Nestlé schemes, pension schemes in the UK and Switzerland, and I keep talking about the attractions of long-dated corporate bonds on a long-term basis. Of course, as a wealth manager, you can lose 10% like that in a year. Yeah. But if you're a pension plan, you want to earn that 1.5% compound over multiple years. So I do find it a bit frustrating that they buy index linked.
So they say we're happy with index linked. But is that a risk thing? Why are they?
It's an accounting thing. Those in the room, IAS 19.
IAS 19. That's a whole new debate.
Must buy. Yeah, we haven't got time for that.
Unfortunately, I haven't got time. Would anyone like to ask Alan a question?
Yeah.
We must have answered everybody's questions.
Well, sterling is a bit esoteric, isn't it, these days?
We have a poll result. Let's have our poll results. Oh, we do have a quick question. Then we'll have poll results. Then we'll move on to the next interview. If you just give your name and then the question.
Hi, I'm Ali Makani. I cover UK for investor solutions business for Natixis. The question is, do you have any interest to access the euro markets through credit-linked notes in quantoed into sterling? Do you think that kind of illiquid but lightly structured product would have a place for? It's not a long-term investment, but at least for 10 years potentially you could have liquidity.
So credit-linked notes taking default risk, principally?
Yeah, default risk on European names.
We do like taking default risk, so we own CLO equity, which is purest form of deal risk, but in investment trust form. So this is the issue, is that generally wealth management has gone towards liquid investments, again because of regulation. Coutts used to be a big hedge fund investor and would have been in a liquid credit, typically in fund of funds, but basically RDR has pushed Coutts and other wealth managers in the UK towards liquid investments, more UCITS. So inside our multi-asset funds, it's more easy to own investment trusts that play in that space. We'd be open to it if it was structured right, but we do think there's overcompensation for default risk. I saw this firsthand at my old shop just very briefly. You shouldn't probably ever talk about this, but I'll talk about it because it gives an interesting insight on default risk, because it was a personal investment. It was the iTraxx 125 names. I did a trade in 2007 taking default risk on the 125 names. And how stupid was that, right? Because it was ahead of the financial crisis, 08-09. Out of those 125 names, only one defaulted, mainly because it's senior bank date. It's almost like a good quiz question. It was Thomson, the French electronics company, and the recovery was strong. The point being, I took default risk for 10 years on 125 names and got ridiculous compensation. Don't worry, it's not life-changing. I only put about £10,000 in. It's not life-changing. But the point being, just like CLO equity, I do believe if you break down the credit spread into the if you like, the component for pure default risk, it's way overcompensated, and that's an example I saw firsthand, even over the financial crisis. So end on that happy note.
And let's end on that happy note. Well, thank you very, very much indeed for your valuable insight. I'm sure we've learned a lot today. I think we've got our poll results somewhere. So 44% think it will lead to instability and uncertainty, which is bad for borrowing. Actually, no, and also 44% on we've learned to live with uncertainty. So there we go. That's yes, an uncertain result. Used to those. Great, thank you very much.